Hey everyone. So we're just gonna wait a couple of minutes for people to get time to join. Um, so the scope of today's presentation um, is nothing fancy. Over the course of the past couple weeks, um, a lot of new members came around, which is great. And we'd like to take the time to make sure everyone has a very good understanding of the basic fundamentals of these dynamics. So today we'll be covering some pretty basic stuff regarding gamma and charm. All of this content, well, most of it is going to be available on our YouTube channel. However, the reason we want to make this live session is because we actually want to go into some case studies, go into some dates, um, different trading sessions, and of course, answer your questions directly with the usage of our platform. So we want to make this more interactive. There's going to be some theory at first. I'm going to go through it pretty fast. Of course, the idea is just to be able to answer your questions. And going from there, we're going to move to some examples. We're going to go over the different modules that are available on our platform. Cool. So can everyone see what I'm currently sharing? Great. So let's begin. So this is a pretty basic PowerPoint, nothing fancy once again. So first of all, we need to understand why we're looking into options in the first place, right? So obviously the options volume exploded during the past couple of years, particularly since the launch of the daily 0DT options on the SPX. So the notional amount of money is enormous. And naturally, we're seeing sums of money being injected into the option market that is simply too great to ignore. And naturally, these amounts are so large that naturally they end up moving the underlying market itself. Another thing is that the daily 0DT options change the market because of key dynamics that we're going to be covering later during this short presentation. Essentially, the 0DT broke the market, in other words, and everyone's gambling on 0DT options, and of course, also making some different trading strategies. So why a trader should care? Well, of course, if the options move the market, well, it matters for the underlying price, whether you're trading SPY, ES, or whatever that is tied to the S&P 500. Here, we're going to be focused more on the SPX, of course, which is the core of our platform. Um, Naturally, this type of analysis is going to work best for the SPX, where the option volume is huge. And naturally, of course, it will drive the market because of the key hedging dynamics. And yeah, I mean, and if you understand this naturally, well, it is going to give you an edge. And as a trader, that's what we want. So naturally, gamma and charm are just formulas, okay? They're simply derivatives based on the option pricing. They measure the sensitivity of the option delta, okay? And naturally, just talking, there's a lot of hype around gamma, around charm, around all these Greeks. But naturally, we just need to understand the core reason we're actually tracking those. And by themselves, if we're applying these analysis um, onto the wrong data set, for instance, well, it's useless. We really need to use gamma and charm, on the proper positional data to have a proper insight on the potential hedging response of the market makers. Naturally, you can apply gamma and charm to your own option portfolio to understand how your P&L might be changing according to a change in underlying price, a change in the passage of time. But in this context, our goal here is to grasp an edge as a trader by doing such analysis on proper positional data. So, like I said, we have to apply these formulas, these Greeks to the right data set. That's number one. And why it matters, well, you're going to see. I mean, if you're here, probably you know this is going to give us some uh, pretty cool levels to be trading off. Um, Also, it can help us understand the potential drift the underlying price can have. And naturally, this is an edge that we can use in our trading. Look, this is not the El Dorado. This is not like everything. It's a big piece of the puzzle. And we need to understand first the limitation of the data we're looking at. And at the end of the day, grab a piece of, grab a piece of the pie while we can. So. So in order to understand that, we're just going to go quickly over some basic mechanics. And by the way, all of this is available on our YouTube channel. If you're wondering, uh, we spent a lot of time building nice little videos. It's the Option 101 series. If you have the time, we split these videos in about 10 minutes duration. If you don't have the time to watch them all at once, it's perfect. You can just watch a video, pause, come back, take some notes, and then continue the series. But now we're going to dive into briefly into the basic mechanics, which is the market makers playing as the middleman in transactions. So I guess the audience here knows when you click buy or sell on your brokerage account, naturally, if you're getting filled so fast, it's not magic. The market is a zero sum, it's a zero sum game. So if you're getting filled on your purchase, or let's say you are buying 10 SPX calls, well, probably most likely there's going to be a market maker on the other side of that trade selling you those 10 SPX calls. Um, and you're not the only one. It's pretty much everyone in the market. And market makers are not only on your option, on your strike, but pretty much on the entire option chain. They're on the bid, they're on the ask, and by the end of trading sessions over the days, over the sessions, they end up accumulating huge residual positions, right? And their job is to stay uh, non-directional. They profit from these transactions naturally. They can profit from managing these positions properly. But one thing is sure is that they do not want to be holding any directional risk, and they proceed with delta hedging in a systematic manner. Okay, we're gonna get into it very shortly. So their goal is not to gain the opposite of your position. They're not there to bury you. They're simply playing the middleman in the transaction, and they have hedging obligations. And as we know, I mean, we probably all went through it, buying options out of the money options and seeing them go to zero very fast. I mean, I've been there, don't worry. But options, they move fast. They move very fast. Their pricing moves extremely quickly. And the main risks during a trading session that have a very large impact on the option price are the underlying price, which is measured with delta, the passage of time. We all see the theta decay when we go in these lotos. Uh, so this is the effect of the passage of time, kind of eating off the premium you pay for your option. And of course, Vega, a very important one, which reflects the change in the option value when the IV is changing. But one thing is very cool and interesting is that delta is directly linked to the underlying asset. It has a direct correlation with the underlying asset. And when you're a directional trader, or I mean, a directional trader, this is very important for you because understanding how delta changes and how the market makers have these hedging obligations with respect to delta, you can understand different things. We're going to get to it. So like we said, this is just a little schematic. And by the way, I'm going to share this on Discord, this presentation. It's nothing fancy. Most of it is screenshots from some of our YouTube videos, which are very nice. You have to go look at them. Um, but in essence, first order Greek, like we said, are describing how the options price is changing. And then the second order Greek, in this case, we're going to be focusing on the second order of delta, which are gamma, charm, and vana. Today, we're just going to be focusing on gamma and charm. There's going to be another presentation on vana in the future, which is going to be very cool. But essentially, these are looking into how delta of an option is changing. And this is going to be very important to understand how these market makers are going to be managing this delta that is directly linked to the underlying, which can give us some directional insights on the underlying itself. So like we said, delta links the options to the underlying. And when the delta changes, of course, the hedge these market makers put in place must change. And this is going to create a direct buying and selling pressure in the underlying asset. And this is what we like, and this is what we want. Whether we're trading futures, like I said, the ETF, SPY, whatever, directional options, that's cool. That's what we want. And of course, like I said previously, it's very important to apply this analysis on the right data set. So you're going to see many pages, especially with the era of vibe coding. Pretty much anyone can come up with some little dashboards. And one thing that is setting us apart is the quality of the data. If you're using open interest of any naive assumption with respect to the market maker option positioning, it's not going to work. I'm sorry. You need proper data sets to work with in the first place. All right. And these proper data sets, we openly disclose that we're using exchange tag data. Okay, there's nothing shady with us. Options Dev, we are all about transparency, and this is why most of you are here today. Um, and naturally, this is the best source you can get, and this is why there is this limitation with the 10-minute interval currently on our website, is because it comes directly from the source. The exchange knows exactly who owns what. Okay, and we're using these data sets to create our models and our analytics that are so popular here on our platform today. And I just want to show you the open interest to make you understand that the open interest, I mean, it doesn't tell you anything. Just let's be real. Other than understanding the interest in a particular option, like the name says it, it has nothing to do with the actual position. Particularly lately, since the 0DTE craze, well, options are not used like they used to be used in the past. People use them as speculative instruments. People buy calls, sell puts, uh, whatever mix of different combinations. And there was in the past these assumptions that were made where options were used as a hedging instrument, where firms and people managing their portfolio would be selling calls of their underlying asset and buying puts as a form of protection. So selling calls to grab some premium and then I said selling calls to grab some premium and then buying puts as a form of protection. But that's not true anymore. All right, this doesn't work anymore. Maybe it worked in the past where options were not so popular at the time, but this is simply not the case anymore. And if you want to build something solid in terms of analytics, well, you cannot use open interest. So just have a quick view on this slide. For example, let's say you're a trader. On day one, you choose to sell 5 contracts of the SPX, whatever option contract. Well, on the other side of that trade, there needs to be another customer or a market maker. There needs to be another market participant, right? But on that day, you're going to notice on day one, this customer sold 5 contracts, but on the other side of the trade, it was another customer who actually bought 5 contracts. The market maker has a zero position in this situation, and you're going to see that the open interest is 5 because there are 5 open contracts on this particular option. On day two, another example, trader one buys 5 contracts, trader two didn't show up that day, and this time market makers are short, taking the opposite side. So now with the same open interest, we have a completely different view of the market maker's option position. They started with 0 on day one, and with the same open interest the second day, they have a short position of 5 contracts. And the same is true once again. Market makers can be long 5 contracts, and on the other side of the trade, there's a customer who is going to be short 5 contracts. And once again, the open interest is 5, and now the market maker's option position is 5. So we can see like a 200% discrepancy in the actual market maker positioning, where the open interest showed the exact same thing. So don't use open interest if you're serious about your trading. That's the number one. And this is actually the reason we created options depth and we started to work in 2022 is because there was no other platform using proper positional analytics, and we had to do it for our own trading. And then this project with Youssef here present in the call, and I built up into being options that you see today. So yeah, this is a quick note. I just really want to stress the importance. You can use open interest just to have an understanding of where liquidity is, where the interest of the market is on the option chain, but using it to understand the market maker's hedging, like, well, come on, man. You can do better. So yeah, just a little note here regarding the actual positioning. So now we need to understand, okay, we have market makers, they're the middleman. Um, they hedge delta. How does that work? Okay, it's not complicated. We're gonna make it as easy as possible. Um, Essentially, there's two steps. When you open a trade or you see a trade on the tape in your brokerage account, understand that the market makers has already hedged that position. Like Drake's album, if you're reading this, it's too late. It's the same thing, right? If you're seeing this on the tape, it's too late. The position is already hedged. So, for example, let's take the same example we had a couple of slides back. Here you have a customer buying 10 SPX calls. The market maker here is going to be selling those 10 SPX calls, and he's going to accumulate a delta of negative 300, okay, on this position. Well, immediately this position needs to be hedged right away, right? So here you're going to see the market maker is short 300 delta, and to hedge this new SPX position, what he has to do here is purchase ES contracts to rebalance this delta position, right? His goal is to remain delta neutral. So whatever delta he has, let's say negative 300 delta, he needs to add 300 delta to remain completely neutral with a zero delta exposure. That's the goal here. This is simply made. The entire presentation is going to be based on understanding these mechanics. Market makers just want to maintain their delta exposure at zero. That's very simple. Okay. But one thing to note is, see this market maker, he's not too fat, but his delta can increase, decrease, okay? And as market condition changes, essentially, let's say the price is moving up, moving down, time is moving forward, the delta of an option will change. And naturally, that hedge is not going to be good anymore. It's going to be shifting, all right? If the market makers becomes heavier, it's going to start tilting, becomes skinny, it's going to start tilting on the other side, and we don't want that. Okay, he's going to accumulate some directional risk in his portfolio, and he's going to put himself in position where if the market moves in a specific direction, he's going to get hurt. He doesn't want that. That's not his business model. Okay, so the initial hedge, we can't really predict it, right? We can look at the flow to have an understanding of the customer sentiment. There's a lot of platforms available for that. However, it only shows you the past or like the present, but nothing in the future, right? If Trump tweets or something, it's not gonna help you with that beforehand. Okay, so it's a good way of understanding trend. Okay, trend, but it's not a good way. It's not a way of understanding the hedging impact. To understand the hedging impact, you have to look into the actual entire option position portfolio. This is what you want to look at. Okay. And here comes the continuous adjustments that can be tracked with the help of second order Greeks. So as the delta changes, what the market maker is, they're going to have to re-hedge. Okay? So if the delta increases in their portfolio, they're going to have to sell. If the delta decreases in their portfolio, they're going to have to buy. All right? And this can be tracked and even forecasted with the usage of second order Greeks to understand how is their delta actually changing right now. And we can also make some projection and see, okay, how is the delta going to be changing later in the day if the price is a bit higher, a bit lower, right? So this is the core idea. And now what we have is a forward-looking tool. We don't have simply an understanding of the past, of the trend, but rather we have a forward-looking tool where we know market makers will be hedging. right? And this is going to be very helpful. So like we said, first order Greeks, delta, theta, vega, these show you how the option price is changing, right? Second order Greek, we're only focusing on the delta here. Gamma, charm, and vana, there are other second order Greeks, but these are the most important within a trading session because these are the most dynamic things that change. The underlying price goes up and down, time to expiration with the 0DT options, we're going to see is very important. And also if IV changes, this is very dynamic during a trading session. Now there's other Greeks that add some layer into complexity, but they're not necessarily dynamic within a trading session, whether interest rates are changing. It doesn't happen every day. Um, so yeah, these are going to be the core Greeks that is going to be helping us forecast uh, intraday movements based on the delta hedging response of market makers. So a little recap here. Options are huge, a huge amount of money being injected into the options market to the point where the underlying follows the option market. Market makers hold a lot of risk. To manage this risk, they have to use delta hedging for their directional risk. There's other types of risk, but here we're focusing on delta. And we can forecast their hedge knowing how their delta is going to be changing. And this hedge, when a market maker, well, when market makers hold enormous amount of options, well, this hedge is going to be an edge for us, right? It's going to move the market. That's very important. So let's begin with gamma. Does anyone have a question here? Before we continue here on Discord, we'll be looking at the messages. Yeah, so Mars is asking, are you going to share the slides? Yes. Is this being recorded? Yes. Um, yeah, so Aaron Dav is asking, so when do we know when the market makers are hedging? So naturally, we know market makers are hedging continuously. Depending on the firm, they're going to have different thresholds of accepted risk, or simply a systematic approach where it's pretty much just a computer running and hedging the portfolio at all times. So in this approach, as a trader, we can only assume that market makers are hedging at all times, all right? And we can make projections, see where the most important concentration of change is, and see it as a probability where market makers are the strongest. Does that answer your question, Arendav? Of course. I see two more people typing, so I'm gonna wait just for you to continue. Yeah, like Yusuf is saying, I'm gonna repeat Yusuf because I think the mainstream is not capturing your voice. So yeah, essentially, I like to see it as a probability, right, of potential hedging response. If you see a very strong concentration of gamma exposure at a certain area, well, understand that there there is a greater odd of seeing a stronger hedging response in this particular area. There is no certainty whether, like, unless you're an insider within the firm and you have direct knowledge of when and where these market makers are going to be hedging, well, you can only assume and, trade with a probabilistic approach, and I think this is where we're going to find success. Great. Let's continue. So gamma, like we said, gamma tracks how the delta is going to be changing when the underlying changes. All right. Look, these charts are not fancy whatsoever. Okay, just bear with me. Uh, uh, so here on the left side, you have uh, two different plots. On the top side, you have a call options delta, and on the bottom, you have a put option delta. Okay, we're going to notice that the option of the call varies between 0 and 1. Okay, but here the strike price is 100. Okay, what we're going to notice is that, of course, out of the money calls are going to have a smaller delta, and as the option becomes in the money, you're going to notice that the options delta is going to start moving and rising towards 1. Okay. Keyword here, rising towards 1. Okay. And we're going to notice that the slope is going to be sharper as we approach towards the expiration. So you see the blue line here is 10 days to expiration, and the orange line here is going to be 1 day till expiration. Okay. So we're going to notice that the slope is going to be more and more increased as we approach towards the expiration. Faster the delta is going to move to 0 as it gets out of the money, and faster the delta is going to move to 1 as we get in the money. Now let's move on to the puts. Very important here. You're going to notice that the delta is between -1 and 0. All right. And we're going to see the delta increase, just like the calls. All right. It's going to increase with the underlying price from -1 to less negative to 0. Okay. So what do we understand here is that delta is increasing with the underlying price for an option. And gamma measures that change. It's simply the derivative. So you don't need the calculus class here. It's just the slope, right? The slope is what is drawn here. It is the gamma versus the underlying. And you're noticing it's forming just like a bell curve. You don't need to make calculus or anything. We'll take care of that. Okay, just focus on the charts. You're noticing that the gamma is positive for a call and the gamma is positive for a put. It doesn't matter whether it's a call or a put. Okay, puts don't have negative gamma; they have positive gamma. What makes the gamma negative is if you are short the option, whether it's a call or a put. We don't care. Just like we're seeing here, the gamma is the rate of change of delta with respect to the underlying. That's the most important line I'm going to say here for gamma. Gamma is always positive for long options, and it's always negative for short options. Okay? Is this clear here? If you have any questions or you don't understand, just like say something here in the chat, in the public course chat. Great. I'm seeing one more question or message being written. I'm just going to wait for it. I'll wait 5 more seconds. All clear, but okay, here is a question from Iron Dav. So when I client buy an option, gamma is always positive. So like I said, gamma is just a measure that can be applied to a portfolio of options. So for you, for your portfolio of options, right? If you own options, if you're long options, your gamma is going to be positive. But if a market maker was on the other side of that trade, he would have been short those options, right? And naturally, if you're long gamma, well, the person who has been on the other side of the trade, assuming he has no other option position, well, he's gonna have a negative gamma. So it's really that simple. Long option equals positive gamma. Short option is equals negative gamma. It's that easy. And as we approach towards the expiration, the magnitude of gamma is going to increase. You see that slope going sharper and sharper? Well, this is the magnitude of the derivative. This is the importance of the magnitude of gamma. And you're going to notice that it's going to shrink towards the strike price as we approach towards the expiration. Yeah, correct, Arendav. So if the market maker is short gamma, is short call or short put. So with delta, we know the direction. Yeah, in essence. But the direction for the market maker doesn't really matter since he's hedging it. Like he doesn't want to be with a positive or a negative delta exposure. He's going to be hedging that. Okay. So from the get-go, as soon as he enters a new position, this trade is going to be hedged. So naturally, his real delta, you don't see his hedge, but you know it's there. Okay. He's going to be with a zero delta exposure net in his portfolio. Of course, his option portfolio can have a very high positive delta exposure, very low negative delta exposure. But the important thing is here to understand how the delta is going to be changing. Okay, and this is the edge here. This is where we can understand the market dynamics with respect to these second order Greeks. So let's continue here with gamma. I pretty much talked over most of the following slides. So the observations, gamma is always positive where it's a put or call. It increases as the expiration nears, and it narrows down near the strike as the expiration is approaching. And when it's gamma negative, it's only being short the option. It flips the curve upside down, and it's true for short call or short put. It doesn't matter. It's not puts that have a negative gamma. That makes absolutely no sense. Okay, just delete that from your head. So as a trader, so we understand positive gamma. Market makers need to hedge, right? If the underlying price goes up, the delta goes up. Let's go back here. The underlying price is going up, right? Here from let's say 95 to 105. The delta is increasing. This is in a positive gamma environment. So as a hedging response, if their delta of their option portfolio is increasing, they're going to have to be selling the underlying. Okay. Now in a negative, well, let's just go with the other scenario. If the underlying is going down, here the delta exposure is going to start up and decrease. Okay. And naturally, their delta exposure is going to be decreasing. So as a hedging response, market makers are going to be buying the underlying to hedge. So in a positive gamma environment, the hedging response is opposite to the price move. If price is going up, market makers are going to be selling. If price is going down, they're going to be buying. It's as simple as that. There's nothing fancy. This can be summarized just by that here. And a negative gamma environment is the opposite. If the price goes up, the delta decreases. And now they need to buy as the price is going up, which can create acceleration in the underlying price. As the underlying price is going down, the delta is going to be increasing, and as a hedging response, you're going to have to be selling the underlying. So here, I'm going to share this slide with you guys. I mean, these slides at the end. So this is just a little summary. So keep that in mind. Gamma is reactive. Okay, so when you're seeing, this is a screenshot from today. When you're seeing the underlying price, all right, gamma is going to tell you a reaction of a change in underlying price. See it as a vertical axis. We have other timestamps forward looking. It's just to give you an idea of what's going to be happening in the future. All right. But gamma is strictly related to a change in underlying price. It's a vertical axis. Okay, on your candlestick chart. And it's reactive to a change in underlying price. Yeah. So a recap, gamma is positive for long options, it's negative for short options, and it's reactive to a change in underlying price. And when market makers have positive gamma, they buy and sell against price movements. And when gamma is negative, they buy and sell with price movements. Charm. We're going to try to wrap it up fast here so we can get into some examples. Today and yesterday were very prime examples. Any day, if you guys have any dates in mind, prepare them. We can go through them. So charm here, similar to gamma, charm measures the change in delta as the time is moving forward. Okay? So here, for example, there's going to be two traces. There's a light blue one, right? On the upper side here, it is for a call, and on the downside here, it is for a put. So we're going to be noticing here. So this is a 30 DTE call. You can notice a smaller slope. Okay, the delta is increasing with the underlying price. And then here we're seeing a 5 days till expiration call. We can see that the slope is stronger. But what we notice here is the change. Notice how the change has been highlighted here in green. So as time moves forward from 30 days to expiration to 5 days to expiration, we can notice that above the strike price, the delta has increased, whether it's for a call or a put. Okay? And below the strike price, we can notice that the delta has decreased. So for a call option, here above the strike price, it increased from, let's say, 50 above 50 towards 1. All right. And below the strike price, it decreased from below 50 towards 0. And for the put option, similarly, you're going to notice above the strike price, it increased from above negative 50 towards 0. It's still an increase, even though the values are negative. It is still an increase. And similarly, below the strike price, while the delta decreased from, let's say, below 0.5 towards negative 1. Okay? So we're noticing here there's a similar pattern, whether we're talking about a call or a put, even for charm, just like we've seen for gamma. Okay? What will matter, once again, is whether market makers or your portfolio is long or short options. And this is where there's going to be a difference in dynamics. So here is just charm versus the underlying. We can see, just like I described, that above the strike price, charm is above 0. That means that over time, the market makers, or over time, the delta exposure increases. Below the strike price, as time is moving forward, the delta exposure is decreasing. Okay? Very simple. You don't have to go into the maths. Okay, we'll take care of that. Take care of that, put it on platform so you can focus on trading. So here, like I said, observations for a long option, charm is always positive above the strike and negative below the strike. It increases in magnitude as the expiration nears and narrows down near the strike in a similar fashion as gamma. And the opposite is true if you're short the option. So it's going to be positive below the strike and negative above the strike. So it's just like flipping upside down this chart. Essentially, you're holding -1 contract in your portfolio, so everything is multiplied by -1. And now as a hedging response, is kind of counterintuitive, where the positive charm is suppressive. You think that positive is good? Well, in this case, it's not good for the market. As the delta exposure increases over time, right, market makers need to sell futures to rebalance their delta back to 0. Right? If the delta increases of their option, well, their hedge has to be in the opposite direction. So if the delta increases, they're going to have to be selling futures. Okay, so positive charm is suppressive. And negative charm, okay, is going to be supportive. Here, if the delta exposure decreases, market makers are going to have to buy the underlying. So negative charm is supportive. And see charm as passive wind, all right? Opposite to to gamma, tram goes with time. Time always moves forward. Unless you're a magician, uh, yeah, time just moves forward. So it is a passive wind that has to happen. And in opposite to gamma, where we track the vertical change in price, here we're going to be looking horizontally to understand the time spent, all right, in a suppressive or supportive trial environment. This was yesterday. You notice that we spent the entire session in a supportive environment and we saw a rejection near a suppressive trial environment. It's passive. And keep in mind, it's a piece of the puzzle, right? Trump can be tweeting some, let's say some bad words, but he can be tweeting some dumb stuff and, market can can turn around pretty fast. But at the end of the day, you have a knowledge and understanding of these option dynamics that will matter for most of your trading sessions, and you can build strong foundations for a trading system. So recap for Charm, long options, they attract. It is supportive charm below and suppressive charm above, which tends to bring the price towards the market maker long option. And short options repel. So it's going to be suppressive below the strike, pushing price below, and then supportive above the strike, pushing the price above, further from the strike price. And charm helps forecast drift. It's not certainty, it's just a drift that can be quantified. So this is the theory part uh, of this presentation. So here the Roman trader is asking, the charm recap is for the market maker perspective. Yeah, and here the end goal is to understand the market maker's hedging response. We can apply these analytics to your own option portfolio, but that's not the goal here at Options Debt. What we want is to understand the potential market movement based on these hedging dynamics so that we traders can benefit from potential price movements. Yeah, so this is exactly what we're going to be doing now. So there's no more slides. Okay, these are just going to be practical examples. Um, so what we're going to do is that we're going to be moving to the platform, and essentially I'm going to be covering the theory and how the data, what the data means on each module, and then we're going to go to little examples. Yeah, let's go on today's date. So let's go here on our platform. So this is my personal layout. I'm running like 10,000 streaming things on my computer. Like it's frying. um, I think I need some ice. All right, so we're gonna put the intraday mode just so that we have a view of the latest available data. So here, for instance, we're gonna be covering up the gamma exposure heat map. So what is this heat map essentially? So the goal of this tool, which is our flagship tool, this is the first time we've seen these type of heat maps, whereas they've been invented by Options Debt. Um, what these heat maps do is that they gather the positioning, the entire option position of the market makers. They look at the whole thing, okay? Whether they're long options, 0 DT, 1 DT, 2 DT, 50 DT, whatever DT, okay? Everything is gathered, okay? And what we do based on these option position is that we project across time, price, what will be their gamma exposure of their entire option portfolio at different moments during the trading session. So here, this is the intraday mode. It updates every day, continuously during the trading session. Anything on the left of the black line is historical data. We don't recompute the past. It's useless. What we do is a forward-looking projection. Okay? So every 10 minutes, there's going to be a new line being drawn at a different spot, further and further. And what we do is, this is based on the entire option position of all market makers, is that we plot an understanding of what will be the global market maker gamma exposure at a specific price point at a specific time during the trading session. Because we understand that gamma is highly dependent on underlying price. Like we said, it peaks on the strike price and then it narrows down and gets more and more amplified as we approach the expiration. So this is the importance of understanding how the gamma exposure is going to be changing throughout the trading session. The same thing is true here for charm. We do the same thing. So it is a forward-looking projection, understanding what is the charm exposure of market makers based on their entire option position as the session moves forward, and of course at different price points. And whether they're long, short, whatever expiration, this is all factored in to the heat maps. You don't have to make these mental gymnastics looking at strikes and 10 different expirations. This is all factored in. And a lot of people are asking, why don't we make a 0DT only? Because that's not the true landscape. Market makers hedge their entire option portfolio. And naturally speaking, the 0DT is going to have the greatest impact because we know that the gamma exposure and the charm exposure become magnified as we approach towards the expiration. So the 0DT is going to, generally speaking, have the most important impact. We see some dates where, let's say there's a JP Morgan caller at proximity expiring in 1 or 2 days, then we see some form of impact. But we're going to notice a lot of convexity in the curve of the gamma and the charm. And this is primarily driven by the 0DT option landscape. All right. Even though we're looking at the entire uh, market maker option portfolio. So this is the heat maps. Now that we explain a bit the theory of this module, we're going to move on to the next, and then we're going to get back, of course, with some real life examples. So this is looking at the heat map. Here we're going to be looking at the breakdown by strike. So breakdown by strike here, I'm going to put it in full screen. So the breakdown by strike tells you exactly what is the contribution of a specific strike price, all right, at the current timestamp. So right now the data is as of 240. This was the latest update. So as of 240, at the current spot price at that time, this was the actual gamma exposure contribution of each respective strike price. Okay, this is only the 0DT, but you can select all expirations if you want. All right, it's going to query into our system. And then you can see the gamma exposure contribution of each contract, of each strike price based on the entire expirations. And this is as of 240, right, at the given spot price at that time. It's not forward looking, but you can get an idea. Naturally speaking, when market makers are going to have positive gamma, they're going to be long options because we know long options cause positive gamma. When you're going to see short gamma, negative gamma, where they're going to be short options. It's as simple as that. And you're going to notice stronger magnitude around the current spot price because we know gamma peaks around the current spot price. And naturally speaking, there's going to be a greater contribution of the 0DT options for which the expiration is imminent in a couple hours. And naturally, you're going to see a stronger concentration near the spot price. All right. And a stronger contribution of the 0DT options. If we see some large peaks further out, naturally speaking, it probably means that it comes from another expiration. Because of this dependency on time and expiration, this is a personal preference. You don't have to do it, but this is my personal take. I like to look at position, all right, and I look at the zero DTE position. Um, Naturally speaking, this kind of eliminates the time dependency and also the underlying price dependency. So I'm able to quickly grasp. And also, what I do is that I remove calls, puts. I just put the net. I don't care whether it's a call or a put because we know that the hedging response is going to be the same regardless. So I just like to see where market makers are long option and where they're going to be short options. And this gives me a great context for intraday trading or scalping or little intraday trades. So as we now understand, the breakdown by strike does not tell you the entire story. It just gives you the contribution of each contract or each strike price depending on your settings configuration. So we did this for gamma exposure, we did this for the positioning, and the same is true for charm exposure, Vanna exposure, delta exposure. Okay. And now depth view. So you see this breakdown by strike. Well, depth view is just like having multiple breakdown by strikes stacked one next to each other. All right, and you have numbers attached to it. So you can customize pretty much everything. So you have the exposure type, the calls, the puts, both combined. So essentially, you're able to see very fast with the grasp of an eye what expiration matters the most. So you're able to understand how money is moving. I'm going to be showing you a little feature that I really like about that view here. But essentially, this gives you a broad view. So you don't have to go into your filters and change expiration by expiration to see like, okay, what is going on tomorrow? What is going on next week? What is going on at OPEX? Just open that view, put on broad range, and you can just scroll it and see what is going on at different price points and at different expirations. Okay. And this is the same thing as the breakdown by strikes. It's not a projection. It is the current exposure at the given timestamp, all right, and at the given spot price at that timestamp. Okay. Here you're looking at the gamma exposure for both calls and puts. Of course, we can look at the positioning. We can look at the position of customers and filter by market participant type. So this is just for the hedging dynamics understanding. We look at the second order Greeks and the positioning of market makers. If you want to understand how people are moving their money, that's something I like to do with DevView. You flip it to customers, you select all, but that's not within the scope of today's presentation, but I'm just going to show you because I get these questions a lot. So I'm going to be selecting, let's say I want to see firms or brokers or whatever, all customers, select position. I want to see how they're buying or selling calls, right? And I want to see how they've done so since the beginning of the day. So I go here to the beginning of the day, let's say since 6:30 a.m. today. I click apply, and then this is going to be showing me how customers have transacted calls since the start of the day. And naturally speaking, we're, most of the time what we see is that they're selling calls uh, far above. Um, Rockenberry. Yeah, I need to change streaming service. We had some good friends showing me some streaming platforms. Kind of was too late for me to set it up. I'm using OBS now, but that's like frying my computer. It's like I can't even. Okay. So yeah, here we're seeing exactly how customers have transacted calls over multiple expirations at the same time and over all the strike price. So if you're seeing, um, let's say, green, that means that they're buying these calls. You can see a lot of people bought calls at 7,000 today. It's not going to work, I guess. But you can see further out in the expiration, they've been setting calls here at 7,000 for the 16th of January, here at 70.50. So we're able to see quickly at a glance what are big money doing without using any types of funky filters or anything. So it's pretty straightforward. This is what I like to use DebtView with the most. And yeah, that's a pretty cool feature uh, that we have here. So going into using these with concrete examples. This is my personal view. All right, feel free to copy it. Um, Let me select 0DT. And I want to see the positions. So I like to track gamma exposure on the left, charm exposure on the right, and of course having the net position market makers in 0DT options. I also have my little depth view that I mentioned here, and I have a 3D version of this heat map. Um, so understanding gamma in today's context, uh, in current context, what we're seeing here is a stronger positive gamma exposure. So what that means is that if price moves down, we might see a potential buying response from the market makers, which is going to be creating a support. Okay. The same data here is displayed on the 3D surface. You can see provides great visual understanding. So see these little spheres like climbing a mountain, right? If you want to climb the mountain uphill in the blue area, in the positive gamma area, it's going to be hard because market makers are going to be pushing you against that move. Okay, whether it's on the upside or the downside, market makers buy and sell against price movements in a positive gamma environment. So you have this force acting on the vertical scale. Okay, if price moves down, there's going to be this cushion, this absorption that's going to create some form of support as we try to move towards that peak. Right. So we understand that this area, you see this little peak. When I say peak, it's literally a peak. It's like a little mountain. Let me scroll properly here. So you can see here, all right, it's like a little mountain. Climbing that mountain is going to be tough because market makers are going to be hedging against that price movement. Okay, the same data set here that we're displaying. So moving into this darker blue area is going to be harder for the underlying price. However, this is just looking at the vertical axis of the change in underlying price. Like we said, uh, gamma is only tracking the change in delta with respect to the change in underlying price. It has nothing to do with time or IV or whatever. It's just looking at this axis. So if the spot price is chilling in the same area for a while, well, there's going to be other forces applied to the underlying price. Price can drift towards different areas. And what I like to see and to look to understand this potential drift is charm. So if nothing happens, if there's a rejection, what will potentially happen? And this is where we lean towards charm. Charm helps us understand the potential drift of the underlying. And here we see a positive, suppressive charm environment, meaning that there is an inherent bias towards the downside. As nothing happens, literally, market makers have to sell futures just because the time has moved forward. And you're going to notice that there's going to be charm pushing us or pulling us towards these gamma. Why? Because gamma peaks where market makers are net long options. This is like if market maker had an option to summarize the proximity, it will be a strike price around that peak. Okay? And naturally, the charm forces is going to be suppressive above and supportive below, just like we're seeing here. So it all makes sense. Like the gamma peak is correlated to the charm flip, and it's all coming down to the same principle, where it is the bond. Yeah, once again. Check, check. Is it any better? Is it any better? Huh? Move the mouse? Yeah. It's good? Okay, okay, cool. My Mac has been frying. I need to find a new setup. Okay, let's get back to it. Platform. So yeah, like I was saying, we need the M5 MacBook. It's like M4 is not enough. um, yeah, let's continue with what I was saying. I was talking about the gamma peak. So understanding gamma is strictly based on the vertical price movements, right? It's not about the time. And understand that now moving to charm, charm is simply wind, right? It's just wind. Birdies, they can fly in the wind, but they're going to fly faster or easier with the wind towards their preferred path, okay? So see charm as wind, okay? When charm is suppressive, understand that price might tend to move towards the downside easier, okay, when charm is suppressive. If charm is supportive, the easiest path for the underlying is going to be towards the upside. And naturally, charm is going to find equilibrium um, at those charm flips, at those intersections between the and positive and negative charm. Okay, at the charm equals 0. One second, I just think the live stream on X has ended. Let me start a new one. Great broadcasts. Uh, source. Okay. Uh, you guys hear me? It's like my internet is not good. Okay, good. Great, great. So let's continue. So charm is essentially looking at the horizontal axis and see it as a wind, a preferred path for the underlying. So when charm is suppressive, there's a easier path towards the downside as long as it remains into this suppressive environment. As a trader, I like to pay attention on how price is behaving around those sharp flipping points. These are key areas. Okay. Naturally, those charm flipping points occur near peaks in gamma exposure or lows in gamma exposure, and these are inflection points. Price might go through into the supportive environment and have some form of uptrend, or reject and remain inside a suppressive environment. I don't look for longs inside the suppressive charm environment near the flip. All right, I'm not going to be looking for longs here. I might be looking for longs there. All right. If you're looking for a reversal trade inside a charm suppressive charm environment, do so near a flip, uh, near a peak in gamma exposure. Why? As the price is going down, market makers might be hedging this downside movement into the positive gamma environment. And when the gamma is peaking, see it as a greater probability of seeing a buying pressure from the market makers. This might create a buying pressure. All right. So if you're looking for longs, some form of reversals, looking at our data set, let me revert back to like 10 a.m. And this was today. Like I didn't prepare for that. All right. What do we see here? We see that the price opened near the 69.80 area. All right. Open here near a local strong market maker short option position. And what do we see here? We see a stack of market maker short options. This creates local negative, quote unquote, gamma. price tends to move faster within these stacks of negative or short option positions. All right. So what we see here is a rejection near the gamma flip, near the local low in market maker gamma exposure. And then we see that the price is moving through this stack of short option positions. Okay. It's moving through all of them. And then when do we find support? Gamma exposure is positive. Let's move forward a bit. Where do we find support? We find support here, all right, on the strongest positive market maker option position within the stack of market maker long options. We see that this stack of option is creating a peak in gamma exposure later in the day. I like to look at this peak before in the session because it gives me an indication that there's a high concentration of market maker long options, right? In our pre-market overviews, this is what I refer to when I say peak in gamma exposure. We're looking at these peaks. Right? This is a moderate to mild peak in gamma exposure. And we can see that this stack of positive market maker option positions, whether they're call or puts, we don't care, right? They're long market maker option positions. Well, these created a support. They created a floor for the session. We've seen a reversal, all right? But that reversal was short-lived. What we did is that we navigated again through the same stack of market maker short options. The gamma works both ways, okay? Whether on the upside or the downside. So price has easier facility to move through these consecutive stacked short option positions. We saw here a rejection right above the 75 mark, okay? And then once again, charm remained in the suppressive environment. I don't look for long here. Okay, we're not too far from the market maker charm flip, and charm is suppressive. I'm not going to be looking for a long opportunity when charm is suppressive. I know that the drift is potentially towards the downside. I don't want that. So when I'm here, I look for potential short opportunities. So the end of the market maker short stack, we didn't have to take a short here. It's just understanding these dynamics, and then you trade the way you want to trade, right? So yeah, charm is suppressive, and then we continue falling back once again through this market maker short stack. Let me move back to like 12 because I'm talking at this 10 a.m. timestamp. Can you guys hear me properly? My thing overheated. I think it's getting better. It's good? Okay, good. Okay. So once again, we moved all the way to the 6980 area, 75. And then once again, we moved all the way back into this smaller stack of market maker long option position. And this is creating some support. And into the end of the trading session, this stack of market maker long option is going to pull the price stronger because of charm. And this stack of market maker short option is going to push the price away from it as well, creating this suppressive environment caused by this stack of market maker short option, which is peaking at the 6970. See here, it's suppressive below 6970. And also from these market maker long option at 6955, which we can see here, some suppressive charm environment from this market maker long option, which is pulling the price. So at the moment, there's a potential pinning force, potential, all right? Anything can happen, but this is just the dynamics. So now if I move towards the current timestamp, what we see is there's a peak in market maker gamma exposure right here at 6940. And we see that there is these consecutive market maker long options at 6940. So currently charm, this is all based on the data. I'm not making this up. There is a peak in market maker gamma exposure, potential drift towards the 6940, expected to be more choppy because gamma is positive and gets stronger. So there might be some buying pressure against the downside movement. But as time progresses, we might see this pull towards the 6940 area. Does that make sense? If it doesn't make sense to anyone, like take the time here. I mean, this is what I'm here for. Just ask your question here on Discord. Sure, I repeat it. Yeah, you're lagging. Maybe it's because of me. Next time I'm gonna connect myself with like Ethernet. Uh, just move to this place. It's not the best internet. Anyways, this is recorded, so the recording is not affected. The connectivity issues I'm supposed to do. So that doesn't have it. So I'm back to so while I'm left. So peak maker gamma exposure. All right, will be naturally because market maker longs are gonna create suppressive charm above and supportive charm below. Because there's a peak, there's a little of market maker long option positions. And now here you see that charm is orange, is over time going to be some pressure. And at the same time, positive. So if nothing happens, there will be some pressure towards 940. But this movement for 40 caused by pressure on price move. Potentially, we might see a drift, a slow drift towards 9, where gamma gradually because with right movements, and charm is passage of time. So this is what we can have a look at yesterday's session. Yesterday's session was a prime example. I mean, I don't give signals, but I had to make a tweet. Or like I had to make a an overview of this setup because it was very clean. So if we go back at around 11 a.m. yesterday, or even earlier than that, so this is what we were presented with in yesterday's session. Anything to the left of the black line is historical data, and anything to the right is projected. Let me focus on the area. Let me just like that. Cool. So what do we see? The underlying price was located at 69.63. Um, and what do we see here? Or let's go even before that, because this has been mentioned in our Discord at around like 10:30 a.m. So we've had a very strong push, a opening drive. We opened near a charm flip, and we breached into a supportive environment. All right. From there, charm remained supportive. Gamma remained low, positive but low. All right. You can see the coloration is almost white. When the gamma exposure is almost white, magnitude of, let me scroll properly. Let's say anything below 500, below 300, delta per 2.5 points. This is relatively low. All right. So there's a potential for easier price movements. When gamma is low, there's less resistance or support against price movements because market makers are not buying or selling as aggressively against underlying price moves. Here we're seeing that the potential drift is the upside, and we have a clear bipolar setup where we have a gamma node overhead at around the 6980 area, and we have a local low in gamma exposure at the 6940 area. And between that, what we have is a very clean supportive charm channel. right? So we understand that this local low in gamma exposure at the 6940 is caused by market maker short options. And short options are repellent, right? They push price away from the strike. So what we're seeing here is a supportive environment caused by this repellent stack of market maker short strikes, and also this supportive magnetic stack of market maker long options above, right? So we have two forces. We're in between, essentially something pushing us from the bottom and something pulling us from the top. Right? We're stuck in between. And between that, we're still within consecutive strikes of market maker short options. So we know that we might be moving more easily through these stacks until we arrive at the market maker long option here at 69.65. Here we expect some slowdown. Why? Because locally there is positive gamma, net positive gamma from the strike prices. And then we see that this gamma exposure is peaking at the 69.80, right? And above that, we get a suppressive charm environment. And below that, charm remains supportive, driven by both the upward push from these market maker short options and the pull from these market maker long options. So this was a plus textbook setup. I love playing butterflies when this type of opportunities occur. They can profit massively with a very little risk, especially when we get this little price movements at about 10 to 20 points. It doesn't have to be a massive move, but just a small drift into this gamma peak, into this flip in charm, which is going to be pinning this peak in market maker exposure. So yeah, this is a textbook setup where we can see the duality between the gamma and the charm playing in tandem together. And this is how we can interpret the data and understand how the market is going to be behaving and reacting to these different regimes. Does that make sense? So in today's environment, I personally won't be playing. Why? It's the end of the trading session. There's more risk. So somebody is asking, we're about to approach the 40s. Would you take long or close your shorts? I would close my shorts. Yes. Today I would not initiate longs. Why? We don't have a clean environment. So here we have two consecutive market maker long strikes with about 2,000 contract each. So this might create some support. There's nothing indicative of a potential reversal. There is some market maker short strikes above, which might facilitate movement towards or into the 69, 65 area, but nothing is indicative of a bounce. There's no negative gamma environment. So gamma remains globally positive. Potentially, I'm seeing a drift towards the 6940 or near. I wouldn't be playing it personally. I don't see it as a super A plus setup. I would consider that as a lotto trade. Uh, like if you have some profits and you want to put in a small amount for a potential large return with a butterfly, I wouldn't be against that. But I wouldn't be taking like the main trade of the day based on that setup, like 30 minutes into the close or like less than an hour into the close. But if I had to do something, maybe a butterfly into this area of market maker long, uh, which is backed by this suppressive charm environment into the 6940. This is what I would do. But I wouldn't initiate a short position. Like the move is not technically based on the data, right? We're expecting a move maybe into the 40s, which is like 6 points. Um, I'm not going to initiate that like near the very end of the trading session where there's more volume and other factors and option hedging come into play. So, what environment is suited for a reversal? So, reversal can happen even though we're in a suppressive charm. Like I said, charm is just like a wind, all right? Just like wind. There can be wind towards the downside, but if Birdie wants to fly up, Birdie is going to fly up. uh, so, I like to look in for reversals when there is a sharp movement without any break into a gamma environment. So, for example, this morning we saw a continuous down move that didn't really stop until the market maker long strike, right? And here, this is where I like to maybe play some form of reversal. And the reversal, like the position is going to be based, of course, depending if we're seeing a stack and the size of these positions. If it's like a 200 contract, I'm not going to take that. If there is a stack of maybe a total within two strikes of like 6,000 contracts, then I can understand that there might be a potential for a reversal here. Maybe a short-lived reversal. So don't like hold until the end of the trading session, but just know that statistically speaking, there is a high concentration of gamma. And naturally speaking, we had the sharp move into a positive gamma environment, into the peak of gamma. There might be some form of buying pressure for hedging purposes. So you can catch maybe a 10 point, 20 points. You're not always going to get like a 30-point move. Like be realistic. At the end of the day, you want to be profitable. You're playing in terms of probabilities. So yeah, this is what I would be looking for in terms of reversal. The same thing is true on the upside. Um, and reversals are facilitated when there's negative gamma overhead. Let's say we're talking over reversal when the price is moving down and potentially reversing upwards. There are some situations where price is moving down inside. We've had this in like pretty much entire December. Let me just take a random. Now, this was an Iron Condor day. Poor guy. Uh, let's take the 17th. Yeah, we've had this like entire December was just like negative gamma pocket, suppressive or supportive charm. We moved, let's say charm is suppressive, gamma is negative. So if the price goes down because of gamma, looking at the vertical axis, market makers have to sell if the price goes down. As time moves forward, their delta exposure increases because charm is suppressive, and they need to sell the underlying. This is true until gamma flips back to positive. Oh, there's a little line here. What is it? It's a gamma flip. When gamma is almost zero or near zero, what happens here is that there's a switch into the environment. Very important. From a negative gamma environment towards a positive gamma environment. It's like hitting the gas pedal, all right, towards the downside, and then you're hitting the brakes as soon as you arrive at the positive gamma environment. Here, as price is falling, market makers are selling with the downside move because gamma is negative. As we approach the gamma flip, now the selling pressures, just looking at the vertical axis, right? The selling pressure is transforming itself into a buying pressure. Does that make sense? So what do we expect? We expect a potential support. It doesn't mean we're going to reverse. Charm remains suppressive. There's a potential for a bounce. Why? Because there is negative overhead gamma exposure. If a large customer wanted to buy a couple $1 billion in whatever stock that is big in the S&P 500, we could have had a very large reversal. Why? Because there was negative gamma overhead. See the negative gamma as a risk. Don't see it as a certainty. right? There's an upside vulnerability because gamma is reactive to a change in underlying price. The drift, the potential drift, the direction is looking at charm. Charm is suppressive. So most likely we're going to be pushed down. And here that was the case. We're being pushed down into this area of positive gamma exposure until the close. Charm was suppressive. So this event of a large buying pressure did not materialize. So there was an upside risk because of negative gamma that could have sent stocks, I mean the SPX flying back upwards, but it did not materialize because gamma is reactive, like we said previously. Charm is dictating and showing us the drift and the potential directional approach of the underlying. So yeah, something that we didn't cover previously was these gamma flips, very, very important. So understanding the change in regime. Same is true from moving from a positive gamma environment towards a negative environment. We generally might have some stronger moves moving into the negative environment where we're moving in from an environment where we're hitting the brakes in the positive gamma and then reaching into the negative gamma environment. Well, it's like you're pressing on the gas. It's like market makers now hedge with the underlying price movements. And if the price is going up, it's going to go up faster. But of course, gamma is reactive to a change in underlying price. It does not dictate direction. It dictates potential width and explosiveness of price movements. And this is what you have to remember. Charm dictates the potential drift, and gamma dictates the potential response of a price movement. Yeah, somebody is asking about the OD score. OD score is very simple. I'm going to share with you a little document that kind of explains it. It's just a 90-day percentile. So we look at the positive values. Let me put the OD score here. Um, so OD score is just a way to understand the relative magnitude of the current landscape. So during December, gamma was pretty low most of the month. So if you want to see a different color scale, so this is the absolute magnitude of gamma in terms of delta per change in underlying price. You can also put the OD score, which is going to give you a percentile-based score between uh, negative 100 to positive 100. So negative values are strictly isolating negative values, and positive values are strictly isolated for positive values. So the gamma zero is going to be the same, right? But the magnitude you're going to see is based on the 90-day history, and it's a percentile score. So let's say you're seeing, let's apply the OD score here for that day. By the way, has it been lagging since? Because I feel like my computer is not as hot. Okay, so here in the percentile based, so comparing to the 90-day prior historical values, we're seeing that we are at the 62, negative 62 percentile for negative. So it's the 62 percentile of negative value. See it that way, all right? Here, gamma was stronger, so this is like a 93 percentile of the previous 90 days. So just a relative score based on historical values rather than an absolute scale. I personally like to look at, I mean, I got used to it. So I like to look at the absolute. This is just like a personal preference. I got used to the magnitude over time. Um, but I mean, this is here. A lot of people like it, so it's just for people to customize their charts the way they want. So we're gonna keep on answering questions for another 5 minutes. We're heading into the market close, so we don't want to be disturbing you into that time of the day. So this has been recorded, and hopefully better quality than the interruptions you had because of my overheating MacBook and poor internet. But this is going to be made available uh, on YouTube, on Discord. So the Roman trader is asking, is your net market maker positions for zero DT or all expiries? I like to look at zero DT personally. So for you guys who want to have the same view, we're going to create it together. All right. So we're going to create a new dashboard here. All right. We're going to call it OD Ilias. All right. We're going to have a gamma, have gradient view. And as we discussed, it's pretty funny because I was not even looking at the charts, but we were actually seeing this drift into the 6940. I mean, it's pretty fun. I like to have these Q&As during market hours because it ends up to materialize in real time as I'm kind of showing you guys. So at the end of the day, guys, you are traders. You have to think in a probabilistic manner, and you have data sets that are here to help you. It's not everything, but it's a very good tool if you know how to use it and how to read it. Oh, I need some ice packs. Ice packs. All right, so here we have a breakdown by strike. We have gamma. I had a depth view. I like depth view, but like not my primary view. I'm just gonna put it here. I like the table version. So here I'm editing my layout. And I'm gonna add a 3D view of the gamma. I think it looks cool. All right, 3D view. All right, let's do half-half with the depth view here. Up, resize it. I'm gonna save it. Now it's saved, right? And then I'm gonna change the filters. Look at this. We're moving into the suppressive tram, into the gamma peak, which moved a little bit lower, just at the 69.35 mark. Here, I'm gonna be using market maker. I like position. Here you can have your quick access filters. So I like to see position, the expiration, and the market participant. You can pin or unpin any of these. I like to have these three for quick access. Um, and since we're looking at intraday data, I'm going to put markers. This shows you wicks, high, low, and the previous value and the opening value. All right. And then here I like to look at the position of customers. It's just gonna do all customers. I like to look at position. That's it. This is my layout. And if you want to have the same colors here on the breakdown by strike, you go here in positional insight. What do you do here? You go here in the settings and you can set up the colors for positive or negative. So here positive for net, I have the blue. And then for the negative net, I have the red. This is why you're seeing these negative in red for the net and positive for the blue. And these changes apply on your dashboard. So this is the OD Ilias. And that's it. If, of course, very important, I synchronize the axes of these charts so that when I zoom in into an area, the zoom gets applied across all three charts at the same time. You can also scroll here directly on the axis if you want to zoom in or out. Okay, you can also do that. So yeah, this is how I my primary view, if you want. Great. I think there was, yeah, some people are asking how does change in net positioning since start of the day and prior update help? It's just for you to keep track of what has been going on. I train my eyes to view these markers, so you're able to see how the exposure has shifted. Naturally speaking, it doesn't really change as much. What is most important is the latest value, but it's just nice to kind of understand like, okay, here market makers were long, but now they got short, and now they got shorter since the last update as well, right? So these are gonna be creating more charm pressure, which is gonna be seen as a darker shade of charm. So it's just as a trader, you like to keep track of how things have evolved during the day. Um, so yeah, it's just a cool feature to have on your breakdown by strike. Um, That's great. And you're seeing here the reversal. Like we, it's pretty fun. So as we reached into this peak in gamma exposure, well, the strongest market maker long option position at 69.40, right? You're seeing a small reversal. Is it gonna go all the way here? Not necessarily. Charm remains suppressive, but we've seen this higher density of gamma exposure on the heat map. We correlated it to the breakdown by strike, seeing the strongest node in positive market maker long option position. And I wouldn't necessarily have taken that trade, but if you want to scalp, you can do that. Like you can take a long at 69.40 and close it a couple points after. Uh, that can be done. That's not my type of trading. You trade the way you want. This is not financial advice. This is just explaining these dynamics and how you can profit from such opportunity. Been guess now. Now, I don't like playing pins till the last minute. Um, there's too many factors coming in at the end of the trading session. Uh, I don't think it's good practice overall. So um, I like to play drifts into particular levels. Once the level reaches, choose whether I want to close a position or keep a part of it. Uh, Most of my positions are butterfly based, if you're asking me personally. And in negative gamma environment, since there is a greater chance for broader volatility, underlying realized volatility, then naked options make more sense. Um, but in a positive gamma or a high positive gamma environment, uh, I don't think buying options off Citadel, who very well know how to price their IV, is going to be the most profitable idea. It can work if you're scalping it or holding it intraday, but I mean, you're here to make a living. Like, ideally, of course, if you're here and listening to this Q&A, is that you want to make trading as a living and not as a hobby. So you have to be disciplined. Um, so yeah, uh, kind of correlating to the comments here in the chat. Um, all right, I guess we're gonna end this. Um, if you have questions, like just ask them in the. There's a free events chat room here, right? It's open to everyone. right? Just let me tag everyone here in the Discord. So if you have questions, you can ask them here. All right. And also, there's a special coupon. There's a lot of um, new users here who have never used the platform. There's a special coupon I'm going to be posting here in the free events, which is going to let you have a very nice discount for your first month. So you can use coupon code very nice because it's a very nice discount, all caps. If you want to try it out, it only applies to um, the Pro Max plan. Let me write this here. I'll be posting it in the Discord server in a minute. But very nice, all caps. You can use that. It's limited to 50 users. All right. So feel free to use it. And yes, to answer the question to Pedrito, there's gonna be replay. Okay. So this was recorded. I'll be posting it on YouTube and posting the link here and on Twitter as well, on X. Amazing. So thank you all for joining. We'll be ending this cool little webinar. And like I said, if you have questions, guys, even if you're not a member, like it's cool. Like I'm here to help. I'm not here to. If you don't want to subscribe and just chill, it's fine too. I'm really not here for that. So yeah, if you have a question I didn't have the time to answer, forward it in the proper chat, and we'll take time to answer all the questions. All right, thank you everyone. We'll be hosting these like just going during market hours. So yeah, here.